Good morning, everyone. Happy Thursday to you guys. Welcome to June's edition of the Innovation Leadership Forum. This is our third edition. Just a little bit about those who are joining us for the first time. The Innovation Leadership Forum is an intimate monthly gathering that is designed by RISE and co-organized with our friends at MDEC for like-minded leaders and captains of business to learn about new practices really in the innovation space and also tech trends that are happening in the Southeast Asia region. And on the monthly basis, we curate the content and we invite key subject matter experts to come in and actually share with you guys on what they are actually doing and also share best practices so that you guys can also adopt in your own organization. So we have a very exciting session coming up today. We are expecting about 70 people turning up to our session. And this month's session will be actually on covering the topic of corporate venture capital in the new normal. As you guys are aware, we are going through a pandemic situation and a lot of countries are on lockdown. So it pays to listen to some of the panelists today on what they're going to be talking about in terms of their strategies. But there are also other reasons to attend the ILF. My top 5 reasons for coming into the ILF today is we have brought together 4 investment aces representing 4 ASEAN countries. So we have representation from Thailand, from Singapore, Philippines, and also from Indonesia. And we also have a very strong gender diversity in terms of our speakers. So we have 50% of our speakers are of the fairer species. And we also have them representing different large organizations. So we have one from a large diversified conglomerate, a bank, a large state-owned telco, and also a technology company. And collectively, these guys are responsible for about $500 million asset under management. So it pays to listen to these guys. And last but not least, of course, we have one super awesome moderator. Our moderator is Paul Ark. I will introduce him a little bit later. Just so that you guys are aware, here's the agenda for today's session. Before I go into the introduction of the moderator, I would like to highlight for our attendees, if you have any questions, please submit them on the Q&A page. There is a Q&A button right at the bottom of your Zoom screen. Click on that and you can type in your question, which will be viewed by the moderator and the panelists. So the moderator will then pick and choose the questions for answering. If I can get the team to move to the next slide, please. So we also have a WhatsApp group. It's our Innovation Leadership WhatsApp group for those who are attending the session today. If you're not already part of the WhatsApp group and still want to keep abreast with the latest ILF updates as well as discussion, please scan this QR code. It will take you to a WhatsApp group where there are already about 30 to 40 people there, if I'm not mistaken. We will show this QR code also at the end of the session so that for those who are interested, they can join us. Without further ado, I would like to introduce our super awesome moderator, Paul Ark. So Paul is not a stranger to the CVC space. He is an investment banker with more than 15 years of experience. Subsequently, he joined the retail space and has been helping Central Group, Apple, as well as Microsoft create their retail market entry strategy. In the last 4 years, he managed a corporate VC fund for Siam Commercial Bank and managed about US 100 million AUM. And currently, he is actually the entrepreneur in residence at WeWork Labs, helping to mentor, coach, and bring the next generation of startups up in Thailand. So I would like to invite Paul to come up front to take over the moderating session. Welcome, Paul.
Thanks, Jonathan. It's great to have everyone here. Appreciate everyone getting up in the morning for this. Might be a little bit later for you, but in Thailand, it is 9. Thank you for that great introduction. And for those that are joining us for the forum, I think we're in for a really great session. As Jonathan mentioned, we have some amazing speakers. When I was asked to moderate this panel, originally my first instinct was, another topic on how VCs and startups are dealing with COVID-19. If for those of you that have been following a lot of these online webinars, it's a topic that, for me, frankly, is wearing a little bit thin. But what's particularly interesting about this panel that we have today is that we're talking about corporate venture capital. And corporate VC is a slightly different beast from traditional institutional VC, simply because ultimately, corporate VCs are beholden to a corporate investor, a single corporate parent typically. And so that presents some really unique dynamics in how corporate VCs operate. And so, I think what we're going to do over the course of our panel is first, we're going to explore some of those key differences between, corporate VCs and traditional VCs, particularly in each of the panelists' different markets. And this is, regardless of, pandemics or crises, because I think the corporate VC entity, is fairly interesting and unique in how it works. And then I think for the second half of the panel, we're going to get into how COVID-19 has impacted, that environment. So, we've seen certain changes in the traditional VC environment because of COVID, things like having to do business over platforms like Zoom. But, I think there are going to be additional wrinkles that come with being a corporate VC in this environment. And we're going to explore that in a little bit of detail. Now, before I ask our panelists to introduce themselves, I do want to set the stage a little bit by throwing out a couple of key statistics and facts that sort of set the stage and let us know, just how important corporate VC is, or CVC is, to our ecosystems here in Asia and Southeast Asia. And let me start by throwing out a few stats that come out of Fortune magazine. 77% of Fortune 100 companies invest in venture capital. So this is not a niche business among corporates around the world. 52% of Fortune 100 companies have their own VC arms. So, what was once seen as a bit of a niche part of the venture capital world is actually becoming quite mainstream. Let me throw out a few other statistics. That's on the VC arm. But if we look at deals, where do corporate VCs stand on the global deal scale? Well, according to CB Insights, over a fifth of venture-backed deals, 20% of VC deals around the world have a corporate VC on the deal. So you're starting to see CVCs make their presence known on the deals, but a third of VC dollars are from CVC. So, you have a fifth of deals represented, having a CVC, and 1/3 of those dollars are coming from corporates. So, corporate entities are definitely flexing their muscles. And what's interesting is for the first time, more than half of CVC, or more than half of VC dollars are coming from CVCs. We're seeing that in the US. So in the US, CVCs have overtaken traditional VCs in dollars invested. And then lastly, if we look at all CVCs around the world, 38% of CVC dollars are going into Asia, double from 2018. Just as a quick aside to the person Gunn who asked a question about slides. Sorry, I didn't put together any slides. I just dug these up late last night, so I got a little bit lazy. But I think if you do a search on the internet, you'll find most of these either through PwC, CB Insights, PitchBook. This is this data that's circulating around the internet. Okay, so this panel isn't about me and a bunch of dry facts. It's about some 4 amazing representatives from around the region. So I'm going to ask each of them to briefly introduce themselves and tell us a little bit about what they're doing. And so can we start with Joy out of Thailand?
Hi, everyone. Good morning. I'm Joy. I'm an investment manager at Beacon Venture Capital. Beacon Venture Capital is the corporate venture arm of Kasikorn Bank here in Thailand. K-Bank is one of Thailand's largest banks. Core focus for the bank would be SME and retail banking, with a particularly strong push recently on mobile banking. Beacon itself is about a $135 million fund. We're technically stage agnostic, but our sweet spot does tend to be in the Series A range. We invest in fintech, enterprise software, and consumer platforms. Geographically, so as a strategically focused CVC, we can invest in companies that are registered anywhere in the world, but the key is that they need to have a footprint in Thailand, or a strong interest in coming to Thailand.
Fantastic. Thanks, Joy. Winston, can you tell us a little bit about yourself?
Yeah, good morning, everyone. My name is Winston, and I'm the head of investment of MBI Ventures, the corporate VC from Indonesia's largest telco company, which is Telkom Indonesia, and it's also a state-owned enterprise, right? And the reason why we made this this corporate VC is that telco companies are, their industry is currently maturing, and they're looking to diversify, and as they are asset heavy, they are trying to explore, some of the new emerging technologies that may be able to drive their entire company moving forward into the future, right? And yeah, so we have multiple funds now. The first one is, our initial fund was $100 million, but we've already expanded beyond that, and we'll also have a fund from Telkom itself, fund from external LPs as well. And yeah, we're the sector agnostic. Since we're looking at new emerging technology, we're looking at some sort of like fintech, logistics, new retail, of course, medical technology, edutech for the long term. The investment size is around 5 million, but we tend to increase it even further.
Great, thank you. And for our audience, I guess, again, what's quite interesting between these first 2 intros is that we have one CVC whose LP is solely their corporate parent, and then we have, we have Winston whose parent fund actually manages multiple funds from, including those from outside LPs. Joan from the Philippines also, is a bit of a similar situation where she has both her corporate parent and outside LPs. Joan, can you tell us a little bit about yourself and your fund?
Thank you, Paul. And hi, everyone. So Kickstart is a subsidiary of Globe Telecom, which is the leading telco in the Philippines. But Globe is part of a larger conglomerate called the Ayala Corporation, which is a 186-year-old conglomerate here in the Philippines, one of the largest in the country, with interests that span property, banking, telco and water, energy, industrials, infrastructure, healthcare, and education. So quite a broad set. Since 2012, we've grown to manage $60 million on behalf of Globe, which we've invested in 44 companies so far, pre-Series A to C. But today, Kickstart is the advisor to Ayala Corporation in setting up a $150 million corporate venture capital fund called the Active Fund, which will be launched in Q3 of 2020. So we look to invest $2 to $10 million in Series A to C companies globally that are of strategic relevance to the Ayala Group. Given the breadth of business interests, we look for startups that address the future of transactions, How do we make the acquisition of things more frictionless? The future of work. So how can technology enhance human capability and make work more productive and enjoyable? The future of resources. So how do you create a more sustainable world where resources reach the people who need them? And finally, the future of living spaces, which is how do we create smarter and more efficient homes and buildings and cities? So that's a bit of a picture of what we do.
Fantastic. Thank you, Joan. And last but not least, we have Teng out of Singapore. Teng, can you tell us a little bit about ST Engineering and your fund?
Yeah, thanks Paul and Rice for having me at the forum. I'm Teng and I head up the ST Engineering Ventures, which is the CVC arm for Singapore-based ST Engineering. So ST Engineering is actually a global technology, defense and engineering group specializing in 4 main sectors: aerospace, electronics, land system, and marine. So the group as a whole employs about 23,000 people globally across offices in Asia, Europe, Middle East, US. And our customers include the people in defense, in government and commercial sectors in more than 100 countries. So one of the key growth drivers for the group going forward is actually in the area of smart cities. So we have done like 700 smart city projects across 130 cities. And how we look at smart cities is through 3 main verticals of smart mobility, smart security, and smart environment. We are listed on Singapore Stock Exchange, and typically we do about annual revenues about $6 billion US. So STEV is relatively new. We were only established about 3 years back with 150 million US in terms of AUM, focused on 4 main deep tech sectors: robotics, autonomous technology, data analytics, and cybersecurity. So typically we invest up to 10 million US from seed to Series B stage, but the sweet spot has been about 4 to 8 for the first check. We can lead, we can follow. Thus far, we have invested in 5 startups, of which we led 4. Main team sits out of Singapore, but we have set up overseas offices in San Francisco and Tel Aviv, to help us do our technology scanning as well. Yeah. So
fantastic. Thank you, Teng. I think it's quite interesting that you do have an office in Israel. I know someone else on our panel has done some work in Israel, if that's right, or at least I'm trying to remember. I did a little bit of research on all of you, but I know that
we invested in a company in Israel called
okay.
Yeah.
So I know Israel's becoming quite a bit of a hot spot. When I was in corporate VC, I was spending quite a bit of time out there. So it's really becoming I think those of us in Asia are becoming hyper aware that we're seeing a lot of tech out of more than just traditional hotspots like Silicon Valley. There's pockets of innovation around the world. Now, I think as we get into the questions, I think what's really amazing is because we do have 4 representatives from 4 different countries. I think we're in a position where we can do some very interesting compare and contrast among the 4 of you. So, going forward, I'll be asking each of the panelists the same question, just so that we can see how each of them sort of approach things differently. So in this situation, I do also want to note that while our representatives do come from some of the largest, most powerful companies in each of their markets, CVC is not necessarily a phenomenon that is, just for the very large corporates. You do see some medium-sized companies in many markets, in some cases, some private companies that have their own corporate venturing arm. And maybe it might be a great hint for Jonathan that in the future, maybe a future panel should talk about some of those smaller ones. It would be quite interesting to see how they approach CVC. So anyways, let's get this show underway. Again, as mentioned, we do have representatives from 4 different startup ecosystems. So I want to ask each of you to, start by describing the state of the venture capital scene in each of your markets, particularly the balance between, international funds or regional funds that might be investing into your country versus the homegrown funds. The locally sourced, locally created funds. And amongst those homegrown funds, that sort of mix between traditional institutional VC versus corporate VC funds such as yourself. So, we're a little bit ahead of schedule, so do each feel free to take an extra minute that I've allocated. I'm a little bit of a strict taskmaster on this. But Winston, why don't you spend 2 or 3 minutes in telling us a little bit about the VC scene in your market?
Sure, thanks, Paul. Yeah, my corporate venture capital is basically operating in Indonesia, right? And yeah, let's talk about Indonesia a little bit. So since the start of, I think Indonesia starts at 2009, where the tech craze starts emerging. After the economic crisis, and we saw that a lot of Indonesians are actually going away and studying in the States, right? And they saw this opportunity, since they have over like 260 million population, they're developing some sort of tech that may able to revolutionize business model in terms of the country and the city, especially in Jakarta. And it has been developed, and most of them are actually locally homegrown VC funds, and they haven't get their name yet until until at least like 1 or 2 companies in 2014. E-commerce company Tokopedia has get a large sum amount of money from international VC, and it sets them into a very big market, and they see that the potential is very big. And since then, there's been a growing interest from international funds to invest company in Indonesia. They have taken a lot of efforts to study how Indonesia is different than US or China, how US is their own thing, how China is their own thing, and how Indonesia is also industry that is pretty much unique in the region, right? And I think because of that craze, right, a lot of corporates, a lot of homegrown VCs, and a lot of international VCs are coming into this space. And actually, Telkom is actually the first one to to try to make sense of this, and let's and they said like, let's try to make a venture capital, and scout for this new opportunities, since technology is still a very way up. The future is still very bright, and therefore CVCs now are, I think like all other CVCs, or there are, aside from looking at financial gain, they're also taking a look at corporate synergies, where business collaboration between the corporate and the startup, and how they are able to they're able to make some sort of new business initiatives, or helping existing business much more efficient in a way, right? And so that's the plan, and for the CVCs. And yeah, and a lot of them are still, for the early to the growth stage, I think there's still a lot of homegrown VCs, and for the late stage, they are more on corporate venture capital and international VCs.
Okay, thanks, Winston. And that last point we'll address a little bit later about stages when we get to the Q&A. So Joan, let's hear a little bit about the Philippines. I think your market's quite interesting, because I think in the early days of ASEAN ecosystems, I think things were a little bit quiet in the Philippines, and it seems like in the last 18 to 24 months, there's just things are getting, there's quite a bit of momentum in the Philippine VC and startup scene.
Well, thanks a lot. So yeah, thinking about it as Winston was speaking, right? And I think to say Filipino
Joan, your sound is cutting in and out.
Okay. Hey, Paul. Thanks.
Okay,
Hello?
yeah, I think so. Keep going.
One moment.
Can you hear me now?
Yes.
Okay, sorry about that. Really sorry. The internet cut out. Okay, so I was saying that, here in the Philippines, it's kind of like two waves, right? So 2012 to 2018, I feel the first wave, where you had a lot of B2B and B2C startups come up in the Philippines. But I think the B2C side of it wasn't ready yet. We didn't have enough digital adoption at the time. So that first wave of startups, many of whom survived, were B2B companies more than B2C. Still too early, yeah? Unless you had deep pockets like Lazada or Gcash, right? 2018 onwards, what I would consider like now, okay, we're in kind of the second wave. We are seeing more B2C startups come up. So how I would describe the Philippine startup ecosystem now, it's nascent, but not without kind of activity and bright spots, right? So we've seen some large Series A rounds recently by regional investors. For example, Tonic, a digital bank here in the Philippines or that wants to launch, recently raised $20 million from Sequoia, India. KHOO, which is a fast-growing live streaming startup and a Kickstart portfolio company, recently raised a Series A from Open Space Ventures. And Sprout, which is an HR and payroll platform, which is also a Kickstart portfolio company, raised a Series A from P72 Ventures last year. So we are seeing more regional investors come in to lead kind of Series A rounds into fast-growing companies. But early stage, right? So we're not seeing like the B's, C's, D's that we are seeing, for example, in Indonesia. Locally, I think CVCs probably make up a vast majority of the venture funds in the market, although there are a number of angel and super angel investors who kind of invest ad hoc, and as well as some smaller institutional VC funds. I think overall, what we're seeking to prove right now is that there is a large enough market to sustain a tech company that's worth at least hundreds of millions, if not billions of dollars here in the Philippines. So that's kind of where we're at.
Great, thank you. And let's go to Teng Lip. I mean, I think I don't think anyone is going to be surprised that there is an incredibly vibrant VC scene in Singapore. That's where it's the regional hub for a lot of VC funds. But if you can give us a little bit of color from your perspective, and particularly on the corporate side, because I think when most people think about Singaporean VC, they think about sort of the traditional institutional funds, but we don't hear as much from the corporate side. So Teng Lip, if you could share some insights with us, that would be great.
Yeah, thank you, Paul. So basically, Singapore is Asia for beginners, right? So you always have a lot of activities in Singapore, whether you're going to be Southeast Asia focused fund, or you're Indonesia focused fund, or India focused fund, China focused fund. You all tend to congregate and live in Singapore in terms of the VCs. But in terms of the so that's been going on for a long time, right? Incredibly long time. But in terms of the actual technology ecosystem in Singapore, it actually you've got to look at it separate from that, as a place to live and as a way to mix stuff. So for Singapore, in terms of its technology ecosystem, of course it started. It didn't start, but around the time of the dot-com boom in the late 1990s, early 2000s, there was a very vibrant community, and a lot of it is actually government-led or government agency-led, because they make it very easy for foreign VCs to set up funds in Singapore and grow startups here in Singapore. So at the time, there was a fund called TIF, Technology Innovation Fund, operated by the government, that actually seeded a lot of the local VCs in Singapore. Unfortunately, with the dot-com bust, a lot of the VCs at the time, there was complete wipeout. And again, so there was a dearth for about 10 plus years in terms of how the VC ecosystem actually had to develop in Singapore. And there wasn't much VC activity. There was a lot of growth capital doing minerals, doing shipping, offshore marine and all that. But in terms of technology space, there wasn't very much. It wasn't until like early 2000s early 2010s when it was concerted effort by some of government agencies, EDB, and all that to actually try to grow this ecosystem in Singapore in terms of the investor base, in terms of the entrepreneurs, in terms of government policy. So government policy is always okay. It's very easy to set up business here in Singapore, and it's always very easy to export out of Singapore as well. But in terms of getting the experienced entrepreneurs as well as getting the experienced investors in, so it started, I guess, in the early 2010s. So at the time, we attracted a lot of accelerators into Singapore, incubators and accelerators, to actually start growing startups, whether they are in fintech space, blockchain, platform place, and all that. And they actually grew quite a number of startups, but at the same time, they through Temasek, as well as a lot of other government-linked funds, they also started seeding a lot of VCs, foreign VCs who domicile in Singapore, as well as some of the local VCs. So they tried to grow the whole ecosystem together, and it was successful. Early stage, seed stage investors, targeting early stage companies. Then after a couple of years, then there was a Series A Valley of Death. At the time, then we started growing Series A investors, and then as to sustain the local startups as they grow slightly bigger. So we have a couple of such startups which actually are good test cases. People like Grab and all that. They were actually the recipients of these policies, and as the startups grow today, many of them are in the Series B or Series C and beyond stage, and accordingly, VCs Series B and above are also starting to set up here in Singapore. So in terms of Sequoia Capital, Southeast Asia, Vertex recently raised a growth capital fund. B Capital has moved into Singapore. You have so again, I guess it's as the startups grow slightly bigger, it starts attracting the larger VCs to re-domicile themselves in Singapore. So that is more of the financial VC scene. Then even in terms of the CVC, we have also seen increasing traction, because I guess for CVC it's an increased sophistication to the local VC ecosystem. So even today, some of the government agencies like EDB, they have set up new departments that were trying to grow the CVC community here in Singapore.
Teng, in the interest of time, can you kind of summarize in about 30 seconds the CVC scene?
Yeah. So essentially CVC today it's growing about it's worth about 1 billion in 2018 in Singapore. Given that the overall market is about 7.5, so CVC investment in Singapore is about 15% today. Yeah. Yeah, so it's getting competitive.
I think what's quite interesting, and you mentioned very briefly in passing about Grab, and what we're seeing in this region is an interesting trend where large scale-ups are now forming their own CVCs. So you have Grab Ventures, you have Go Ventures out of Gojek. This is a growing trend. So I think it's quite interesting, what we're seeing in terms of CVC in Southeast Asia, particularly the ones that are achieving massive scale out of Singapore. So that's definitely, we could literally spend an entire session just exploring that, but unfortunately we don't have the time. So that's probably another topic worth exploring at some point later. Hint, hint to the folks at Rise. Now let's get to an ecosystem that's near and dear to my heart. Joy, can you tell us a little bit about the VC scene in Thailand?
Yeah, so the VC scene in Thailand, actually, from what Joan said, seems a little bit similar to the situation in the Philippines, where we're very heavily dominated by CVCs. So I think in about the early 2010s, the first wave of CVCs started up from all the telcos, gradually expanding into bank CVCs and oil and gas CVCs, kind of dominated right now by the large corporations. I think early stage, you have a lot of support from government agencies like DEPA and NIA in terms of grants. But once you start moving into the institutional rounds, there's very few financially focused institutional investors in the Thai market. Occasionally, if you see a startup starting to break into the Series B, Series C range, we'll start to draw a little bit of interest from more regional investors who may have representatives or offices here in Thailand. But the local scene is, I think, it's struggling a bit right now to get all of these seed stage Series A startups to really break through into the regional market, because I think Thailand has the additional problem of not really being a large enough market to really draw VC interest as a single market. And the startups, there are a lot of great startups here, but they're really struggling to break through into a second, third market. I think I can count just a handful of players who have broken through meaningfully into a second market. The other interesting thing I think about CVCs here is that originally I thought CVCs are all strategically focused, but actually if you look at the mandates of a lot of Thai CVCs, there's a decent mix between financially focused CVCs and strategically focused CVCs.
Great, and you're kind of going to be segueing into my next question, but I think it's probably worth noting that I think what we're going to see across the region is that the great majority of institutional VCs will typically be based out of Singapore. And again, to Teng Lip's earlier comment, Singapore is like an ecosystem for beginners. It's English prevalent in terms of language. Very a lot of very fun-friendly laws and regulations. And it's just a very easy magnet for most institutional funds to be based out of. And then what you'll see is sort of the individual corporates with local money forming their CVCs. Anecdotally, I don't have any real data on this, but anecdotally, it seems like the one market where you're starting to see at least some critical mass of local institutional funds is probably Indonesia. I see more about, institutional local funds out of Indonesia than I do in most other markets. And that's probably something worth doing a little bit of research on. But, to sort of get into the point that Joy was alluding to, corporate VCs are a little bit of an interesting beast because, most traditional VCs really cater towards achieving and maximizing a financial return metric. Whereas a corporate VC can actually adopt, either financial or corporate or lie somewhere on that spectrum. And what makes that spectrum a little bit challenging is that unlike financial returns, which tend to have some very well-defined definitions of return, whether it's cash on cash, whether it's return on investment, return on equity, whatnot, it's a bit challenging to define what a strategic return is. So let me ask each of you, where does your fund lie on that spectrum of financial versus strategic or somewhere in between? And if you do incorporate strategic returns in your operations, how does your company define a strategic return? So Joan, can we start with you in the Philippines? Because you've got a situation where you're managing both a parent company fund as well as funds from another group.
As well as a grandparent company fund. Yeah, sure. So in terms of, where we lie on the spectrum, I think the answer for most CVCs is both. And I'm not going to buck the trend here. For us, it is also both. We have metrics that hold us to account around capital deployment targets as well as ROI. We also have metrics that hold us to account regarding strategic introductions. So the number of introductions that we make in a year, commercial deals that we close as a result of those introductions. So those are some of the things that we count. Although we don't, I think, kind of to my knowledge, like quantify, this is the amount or size of the deal that was closed, right? So it's more that our role at Kickstart, we say, is we do two things. We break down barriers and we build bridges, right? So I think the first part, we and the investment team, we seek to identify and present opportunities to our LPs or the heads of the different business units of Globe and Ayala to show them, hey, this is what's going on in the market. Would you be interested to partner with these guys? And we think we can make a good return from this investment. And it's really pushing the boundaries of that particular industry or sector. So we'll go ahead and make the investment. We have a portfolio operations team or a business development team, however you would call it, which works to create strategic value post-investment. And so that involves kind of being in conversation with the different business units, having like this portfolio of opportunities and saying like, oh, what are your problems? How can we solve them with kind of the companies that we have in our portfolio, companies that we've seen. So that's kind of, I guess, our role. We break down barriers and build bridges.
Great. Thank you, Joan. Teng Lip, would love to hear from you on this particular question, especially because, your fund tends to do a lot more investment in sort of the hard sciences space and the deep tech space, which even in the best of circumstances requires some a great deal of patience around return metrics. So how does your company, where does your company lie on the scale, and how do you manage the measurements?
Yeah. So for us, we see ourselves as we see ourselves as the partnership arm for the group. So we are very strategic. So we see ourselves doing partnership with startups, and investment is a stronger form of partnership for us. So we are set up to collaborate with early stage, growth stage startups that augment the group's businesses in the 4 sectors that I spoke about earlier. So our aim is actually to create win-win situations, to build successful collaborative relationship with startups. We take minority stake, we work with them, combine our technologies together and expertise together, then co-create breakthrough solutions. And then at the same time, the startups that we invest in, they'll have the opportunity to integrate into our global business ecosystem, our networks, our distribution channels, So we see this as a win-win situation, as a chance to co-create and form a very tight partnership together. And of course, at the same time, there must be financial returns, because because in many cases, these startups, if they become a department within the ST engineering, then a lot of the innovativeness that we look for in the startups, a lot of the people that look for in the startups, there may be changes. So we must make sure that they remain viable, they continue to remain funded by other VCs, in which case they have to deliver good financial returns. So it's a difficult balance that we have to work with. Yeah.
Great. Thank you, Teng Lip. And Joy, can you tell us a little bit about K-Bank's approach?
Yeah, so Beacon, I think, lies somewhere in the middle between financial return and strategic return. Strategic return probably outweighs financial return a little bit. It increases the level of flexibility we have when talking about valuations and entry prices. I don't really have a satisfying answer on how we measure strategic returns. It's not really something that we have a quantitative measure for. I can say that the way the bank approaches partnerships and investments is basically looking for startups that can provide opportunities for deep integration with the bank itself. So for fintech, I think it's probably pretty self-explanatory about integrating fintech into the bank's own financial services. But for non-fintech companies, it's really about the ability to work with these companies to better understand the customers that they serve, so that the bank can customize bank products to serve those customers and reach a broader market segment. I think co-marketing and deploying bank products, it's nice, but if you're looking for what we would consider a really good strategic return, it's deep collaboration, something unique.
Thanks, Joy. And how about you, Winston? How does MDI approach this strategic versus financial balance, if you do it all?
Sure. Yeah. So this has been an age-old question since the beginning of MDI's, how MDI came to be, right? So the first thing is we used to run this based on synergy. So all the investment has to be seen what kind of synergy that can be created out of these investments. But now, after we realized that we have been operating for more than 4 years and we have seen quite a sizable returns, and now the company, our parent company, has decided to focus more on the financial gain investments, right? So it's kind of I think it's kind of a blend between the two. But now I believe that we are now able to invest in companies that are that the thesis is purely on the financial gain side, which I think there's a significant upside out of this, because we have a lot of giving this hybrid model enables us to invest in a company that that may not be able internally for us, because because we need some sort of synergy, and synergy sometimes work and sometimes don't. And now after we've seen various companies that are able to exit, right, M&A or IPO, then we are shifting some sort of a hybrid model. And now this unlocks our fund to invest in a company that was previously cannot invest. And now since we are also expanding with with external funds as well, we have like a second and third fund. We're opening 2 more funds in the future with different theses. There are some funds that are focused on synergy. There are some funds that are focused on financial gain, but my expertise is more on the financial gain side, right? And since the synergy side is being handled by another team in my company, so I think that's the advantage of what's the blending in between synergy and financial gain.
Thank you, Winston. I think, for those that aren't as familiar with the corporate VC concept, I think the common theme that we've heard among our panelists, as well as CVCs around the world, 2 big issues. One, how do you measure returns? Again, it's from the strategic side, it's a bit of a challenge. And then I think to Teng Lip and Joy's point, a lot of that strategic value tends to revolve around either some sort of partnership or, as Winston mentioned, some sort of synergy. So the challenge, and that raises a whole lot of other questions. How do you achieve that partnership? And even questions of, is investment necessary? Does it enhance partnership? Is it in addition to? And again, that is an issue that sort of plagues CVCs around the world. Just, from a very personal perspective, in my observation, my time as a CVC, I've had an opportunity to talk to corporate venture arms around the world, dozens of them. And anecdotally, what I've seemed to observe is that over time, I mean, all of CVCs go through a very similar journey, and they struggle with similar issues. And over time, I think the ones that sort of wind up surviving decades, companies like, Citi Ventures, Intel Capital, a lot of them ultimately do migrate to a pure financial return only model. So I don't know if it's just a question that we all just sort of wake up and realize, just go for the money. Or they do implement some sort of hybrid, much as Winston mentioned. Google actually has 2 separate VC arms, one specifically for strategic and one for financial. So, what the future of CVC looks like, those companies might provide a little bit of a clue. Okay, so we spent the last 35 minutes or so sort of getting a broad understanding of all the issues that that sort of are on the minds of corporate VCs and our representatives here. We do want to talk a little bit about current events, namely COVID-19, and how it's impacting what CVCs do and disrupt what they do, if at all. Maybe you guys are all perfectly normal. We'll see. So what I'd like to ask is, again, we're looking at a perspective of not just your units and your VC arms, but your parent companies. So your sugar daddies and sugar mamas, who actually fund your reason for existence. So what I want to ask is, not how has COVID-19 first impacted the core business, your parent company, and their prospects, and as a result, has that required your parent companies to slow down or pause the innovation and investment strategy that you guys are executing, or have you guys had to even radically pivot what you guys have done, or maybe the third option is it hasn't impacted you guys at all. So that would be interesting to get a sense of. Teng Lip, can we start with you?
Yes, indeed. The past few months have been very challenging on multiple fronts. While at a group level, our businesses in Singapore, Europe, US, and other parts of the world have been designated as essential services by their respective governments, our near-term P&L has certainly been affected due to multiple factors, right? Shifts in customer demands, supply chain issues, workforce disruptions. So in a way, yes, the mothership is have all these afflictions, but the thing is, we are an engineering company at heart. We're a technology company at heart. So within Singapore itself, my colleagues, our teams have actually rallied around Singapore's COVID-19 efforts, pivoting from their usual work to actually swiftly deploy solutions and provide a lot of technical and engineering solutions to support some of the ground operations. For example, our guys have been setting up infra fever screening systems that screen large groups for fever. We have deployed our autonomous mobile robots that does material handling in a lot of the community care facilities for our COVID patients in Singapore. We deployed our security robots to mitigate security personnel exposure to infection. We set up command and control systems within hospitals to help them to manage patient loads. We also started doing surgical masks and N95 mask production. So in a way, this is how we have pivoted our existing businesses and accelerated our own our own innovation to sort of like tackle the increased digitization as well as automation trends that COVID-19 has brought about. More interestingly, at the national level in Singapore, just last Saturday, our Deputy Prime Minister actually announced that he's going to deploy an unprecedented $70 billion US in terms of a stimulus and investment package. Other than that $70 billion that's been used to tackle COVID-19, he will also set aside about another $15 billion US to support research in high impact areas so that Singapore as a whole can emerge from COVID with massive investment in innovation. So he has decided to go into areas like health, biomedical sciences, climate change, AI, and at the same time, a series of industry-led groups in Singapore has been exampled to explore specifically different opportunities in areas like robotics, e-commerce, environmental sustainability, digitalization of supply chain, built environment, edtech, and all that. So we think that as an engineering company, technology company, we'll be quite well placed, and innovation is going to continue, if not accelerate, with the passing of COVID-19. Yeah.
Thank you. And Joy, can you tell us, how's COVID-19 impacted K-Bank, and has there been any sort of spillover effect, on the Beacon as a result?
Yeah, so I think due to COVID, the financial sector as a whole has been hit pretty hard, but it's something that I don't really think COVID is different than any other economic downturn, which all of the large banks are preparing for in cycles. It's may not have been able to predict that the downturn would come because of COVID, but we're definitely preparing to weather some sort of credit cycle given the past bull market of the last decade. So in that sense, it's business as usual for the bank. In another sense, I think this crisis has really highlighted the importance of going digital. So in a way, it actually benefits Beacon's activities and business because all of the companies that we speak to, all the startups we speak to, that becomes increasingly important for the bank to accelerate its move into the digital space.
Thank you. And Winston, how about your core business as well as your fund activities?
Yeah. To start, telco business is, unsurprisingly, there has been quite a little impact, and in fact, I think there's going to be a lot more people are using. If we're talking about ISPs, right? They also have like a fiber, optic fiber, and also cellular network, Telkomsel. Their traffic is actually going up, and there's a lot of prepaid purchases on top of that, and so we think that their operational business are mainly under control, maintained. So therefore, there's no radical shift from the corporate side has been identified. However, on MDI side, we see that some of our portfolios are I'm not going to name some of them, but just being realistically, not everyone is having a good time, right? Especially on industry sectors that are affected, that requires physical activity such as tourism, and from there, the shift in strategy is focus less on new investments. So we're still scouting for new investments, of course, but the priority here is we have taken more initiatives to put this fund priority for a while to portfolio top-ups for the time being, in order to support them, in order to maintain them in the long term, because this economic downturn is just temporary. It's not going to be impacted like forever. There's going to be like a recovery, and we'll definitely need to support them financially in order to get a comeback, right? And in return, we might be able to get a better deal for both new investments and top-ups. New investment in terms of they're maybe raising like emergency fundraising, or since the multiples are rather slowing down, we might be able to negotiate a little bit just to get more deals for the time being. So yeah, so that's how you can see it realistically, right?
Thanks, Winston. And it's an interesting point, because again, we're talking about industries that either are going to get hit quite hard by something like COVID, and other industries that will see it as definitely, I don't want to say it's a good thing. COVID is a horrible thing, but it does lend itself for the ability for certain industries to move forward. And I'd definitely love to hear Joan's perspective, because you're managing, two different groups. One, Ayala, having itself very diverse interests. So, it's probably got to be a little bit of plus and minus on your end, I imagine.
You hit my first point already, Paul. No, so, as mentioned at the top of the panel, Ayala Corp or Ayala Group is a very diversified conglomerate. So while some business units have been affected, for example, the real estate arm or our industrials arm, because of disruptions to the supply chain and labor, other industries or business units, for example, like Globe, similar to Winston, or AC Energy, our energy generation unit, have been resilient and in fact are registering growth in demand during this COVID crisis or pandemic. I think I also want to echo Joy's point earlier about, I think, how COVID has really highlighted the need to embrace digital, or kind of at the very least the concept of O2O. And I know it's kind of touching to your next question a little bit, but I think for corporates, right, when something like this happens very suddenly, you kind of realize you can't build all of the solutions you need, right? Like, because that's, they always say, right, that's, corporates are like, especially like if you have technical capabilities, you're like, why we need to partner externally? We can just kind of R&D and build it inside, right? But it's all in this kind of pipeline, and you've got the core business to worry about. But when something like this happens suddenly, you realize that you need to partner so that you can respond quickly to changes in the market. So I actually expect there will be more openness to work with partners once kind of the worst of this crisis is behind us. I guess to answer your question more directly on kind of how the crisis has affected us at Kickstart and the initiatives around innovation and venture capital, I think we're very lucky in the sense that, again, Ayala has been around for 186 years. And as such, I think is able to take a much longer term view on things such as innovation. So I think leadership at the company recognizes that this is critical to long-term success. And so we're fortunate that their commitment to, our work, the innovation investment work, has not really wavered. And, in fact, I guess the need for it has only been underscored by kind of recent disruptions.
Great, thank you. And I think what we're seeing from these responses, I think the traditional viewpoint towards corporate VC, particularly from traditional VCs, is that corporate VCs are seen as fair weather friends. The market turns down, the innovation budgets are the first to go, and it looks like it's anything but. In the cases of our 4 representatives here, it could be possibly because they have a certain amount of scale and capital to deal with as a bit of a buffer. But rather than sort of retrenching, batten down the hatches, sort of slow things down, at best, everyone is working towards supporting their portfolio companies. And again, as mentioned, in cases like digital banking or telecom, they're seen as potential environmental factors that might drive their business forward. So I think it's great that we're seeing CVC sort of buck that myth that everyone will run for cover at the first sign of trouble. If anything, it looks like everyone's diving in deeper. So let me ask. Let's get down into a little bit about the last question talked more about overall strategy, both of you and your parent companies. What I'd like to know is a little bit more about how each of you operate. So at a more tactical operational level, I think we've seen there have been any number of webinars and panels and fireside chats about how VCs have to adjust how they go about doing their business when they can't see people face to face, when they can't travel. Horrible. VCs without travel, we're not getting our frequent flyer miles, we're not getting our hotel points. It's a bit of a tragedy. But that's our lifeblood. That's how we operate. And we know about how traditional VCs had to adapt. But what makes all of you very different is that you've got a very strong, you're managing more stakeholders in that, you probably have much closer interaction with your limited partner. And so, you're trying to strike partnerships within your parent companies. So what I'd like to understand is to explore from the perspective as corporate VCs, how have you had to change the way you conduct business, whether it's investment, whether it's doing POCs, whether it's striking partnerships, or, I think in some cases, I know some of you operate acceleration incubation arms. How does that change in a post-COVID world? And, are you anticipating that those changes are going to be permanent, or are you going to be going sort of back to your standard way of doing business once we emerge from this crisis? So can I start with you, Joy? Can I ask a little bit about, how you operate on a more day-to-day?
Yeah, so I think apart from the obvious examples of everybody's now working from home and there's a lot more video conferences rather than face-to-face meetings, I actually don't think our process has changed that much. The decision process is pretty much still the same. It's just taking longer. I think because if you weren't used to working from home before now, it's been a bit of an adjustment, and just the entire process of getting everybody together and getting a decision, it takes a lot longer than it would if people were still working in the office. From an investment perspective, I have noticed a shift towards more concern about downside protections, and especially about figuring out the viability of the company in the short term, which before now, that wasn't really as much of a question for whatever reason. It's more looking long term. Post-COVID, I don't think much is going to change from our perspective in terms of partnerships or investments. Hopefully, there's a little bit more willingness. I think somebody mentioned this earlier, to work through partnerships and with startups as opposed to focusing solely on internal development. Just now that you see the difference in speed. But it's not really a great answer, but I don't see a whole lot of change, at least from our perspective.
So let me ask you, Joy. So in that adjustment, is it both the innovation and VC arm as well as the parent company? Because my general feeling is that as VCs, we're used to traveling around quite a bit. where a lot of the team members are used to operating in different locations and time zones. So doing things like remote calls seems to be kind of standard operating procedure for us. So is most of the adjustment on the bank side and having to sort of communicate back to the bank rather than schlep your way to headquarters?
Exactly. I think part of it is just the bank is a large corporation. So you have multiple stakeholders, multiple executives, multiple decision makers. And instead of being able to get everybody kind of is already in the same building, can easily meet, it's been an adjustment to just get everybody used to the whole video conferencing, remote decision-making process.
Great. And Winston, how are things on your end? Because again, you know, you are, you know, like Joan, you're managing multiple LPs, and so that adds an additional wrinkle.
Yeah, thanks, Paul. You know, talking about what we do different and what's the difference between right now and previously. I think to add to Joe's answer is that I don't think there's any huge difference, like a staggering difference like what we see in the previous economic crisis. So you know, again, I think this is a very, very unique event that we're currently experiencing. But I think that there's not going to be a lot of new, you know, drastic changes. I think downside protection is also something that is currently being explored, but not really enforced. I think a lot of you know, a lot of startups are kind of against the idea, and yeah. So again, what we do is on this pandemic is that you know, talking about new normal. I think the term is currently being overused, and especially in Indonesia, as a part of a government initiative to secure a security protocol, right? So trying to open up the lockdowns, everything. New normal is just another way to hook up unsuspecting people to take a look at this security protocol. And I believe once the pandemic is over, they're going to be go back to the old normal. So it's not really that new, where all your lifestyle are going to change, right? So but we see there's going to be like a small area that I believe will be retained in the future. Especially, I think Singapore, countries like Singapore is trying to adopt this new lifestyle that you know, it's a preventive situation where, you know, they're trying to change. They're trying to anticipate the next pandemic, right? Again, I think there are small area that I believe that is going to be retained, because it's maintaining the difference between health and economics, right? And we're basically living in a place and society where economy make or break us, and therefore, if there's an opportunity, we can take a look at that and try to enhance those features. So what I see that you know, well, a lot of things are going back to normal.
Winston, I'm gonna have to cut you off because the organizers are saying they're asking me to rush things through to get to audience Q&A. So Joan, I'm going to ask you just real quickly, and I'm sorry to cut in your time. Can you kind of give us the quick 1 minute view of how your operations and day-to-day has changed? Sorry, I'm going to ask you.
No worries at all. No worries at all. And thank you to everyone who's still stuck with us through this. No, I think I won't repeat everything that you know, my esteemed panelists have already mentioned. I think the only other thing is kind of, you know, I think there's a need to be sensitive to the situations of kind of our different business unit partners, and kind of what their situation is. You know, if they need to slow down a bit, we have to be understanding of that, because really it's about long-term partnerships and building long-term relationships on both sides. So I think that's really the main point I wanted to raise.
Great. And Teng, can I get your kind of quick rocket 60-second view?
Yeah, I think in the new normal, collaboration is more important ever than ever. So we're still doing deals, but because of the travel restrictions and all that, we are actually cross-checking a lot with the suppliers, the previous investors, our partners, VC partners, and all that. So collaboration is key now. Yeah.
Wow. Okay. Wow. And I got an extra 30 seconds out of that. Okay. So yeah. So I've been asked to sort of at least address some of the Q&A from the audience. And I'm not going to require all of you to answer, but so this first one, which I am throwing out to the group, we have from Creel Price from Investable, which is a seed stage, early seed stage fund manager out of Australia. And he asks that, he comments that most CVCs tend to favor later stage investments as the risk profile is lower. And I think I've heard some of that from you throughout the course of this panel. But wanted to ask, what is your view on seed and early stage, and how can fund managers best build relationships with corporate VC firms so that they can feed deals through when they're ready for later stage investments? I'm going to ask responses from no more than 2 of you, so it's going to be a first come, first serve. Whoever has a response to that.
Yeah, for seed and early stage investments, we also have something like incubators, right? And it's a basically initiative, that may be backed by a CVC. So I suggest that to start off, we can start with the incubators first, and after a while, follow-on investments may be open for the CVC to invest further right after the validation.
Great. Anyone else have a view on that?
Yeah,
sorry, go ahead, Joy, please.
I guess I'll jump in a little bit on that, because we've done one seed stage investment. And I think for us, it's not really so much the risk profile that we're concerned about, it's the footprint. So the one seed stage investment we did is a company which was already present in all 70 something provinces of Thailand. I forget how many we have by the time that we invested. So if you can bootstrap existing traction, I think that helps a lot with coming in at an early stage.
Joan, why don't you chime in, because that was actually a really succinct answer from Joy, so we got a little bit of time.
Yeah. No, so we have a fund that can do seed stage investments, similar to, I guess, what Winston was saying. And then I think on early, early is okay. I think the question is relevance, right? Like sometimes it's like, yeah, I get it, it's early, but how does this relate to my LPs? How does this plug in, right? So it's I think more about demonstrating how this could add value and showing concrete use cases, rather than it being purely about stage.
Great. Okay, and then we have a second question, and it's a little bit more targeted to Joy, actually, or it's more relevant to Joy. So Frederick Lowe asks, is it the best suggestion for banks to co-create products instead of come out with the product itself? I'm trying to interpret that. And I think that's just related to whether you collaborate or just create on your own. And why so, and any other suggestions? And is it always from a fund perspective for a startup company? Okay, that's I'm having a little bit trouble with the syntax. So I'm going to ask, so from your perspective, I'm going to tweak it a little bit. So from your perspective, is it better to partner with startups, or is it better to kind of create your own financial products and features? That's a very binary question, and I'm sure it's a bit more, your answer is a bit more nuanced than that.
Yeah, so KBank has, I guess, a three-pronged approach to technology: build, partner, buy, or invest, not buy. I think there's no one-size-fits-all answer. It's really on a case-by-case basis, and I think it really just comes down to speed and resources. The bank has a lot of great coders, programmers, et cetera, who can develop products internally, but they can't do everything. So I think you focus on the core product, And then when you're moving outside of the core product, it's basically what is the bank interested in right now that it wants to really own on its own. And then everything else, try to work through partnerships because it's just a lot faster. And if you don't have the resource to do it yourself, there's plenty of great startups out there who can help.
Thanks. Yeah, so I'm getting flagged down because we went way over time. And I think that just sort of highlights that CVC is a very, very rich topic. You know, we could have easily taken one of these questions and blown it out into its own session. And, you know, there's about as many CVC models and approaches as there are CVCs. So, you know, it's just been a fantastic discussion. Probably every answer probably raised another 3 questions that I would have loved to have asked. You know, I also will comment from a personal perspective. I've been playing my own sort of version of buzzword bingo this entire time. I've been really amazed that no one brought up new normal. I have not heard new normal the entire day. It's fantastic. I love that. And actually, I only heard the word from Joan at minute 47. So thank you for not sort of, you know, causing my brain to bleed from yet these common buzzwords I keep hearing. So, you know, before I hand it back to Jonathan, I just want to give, you know, a big thanks and a virtual Zoom round of applause for Teng, Joan, Joy, and Winston. Thank you all 4. I really hope to get
Thank you so much.
Thank you, Paul. You were amazing.
Jonathan, back to you.
Thank you so much, Paul, and thank you so much to our 4 wonderful panelists for that very interactive session. We did run a little bit over time, but it was a really lively discussion. I, for one, have learned quite a lot from you guys. In another time, would have organized a longer session. But that being said, I would like to just highlight again to everyone, if you guys want to keep abreast with the latest happening at the Innovation Leadership Forum, please scan this QR code and join our WhatsApp group and get the latest on ILF. We organize this event every month. We will be sending out information on the next event in a fortnight's time. So please do keep in touch with us. So without further ado, again, thank you everyone for coming and thank you to all the speakers today. So I'm ending this session now.
Thank you very much, everyone.
Thank you.
Take care.
Bye. Thanks, Jonathan. Thanks, Yok. Bye.
Thanks, everyone.